Hi guys, we hope you're doing well, and in today's quick video we'll cover the top 5 reasons why you might not want to invest in syndications. So let's begin. Number 1 is lack of control. As a passive investor, you are not really in charge of the day-to-day operations, dealing with tenants, toilets, trash, executing on the business plan, or even making key business decisions. That your role is literally limited to passively enjoying the profits and benefits of owning that real estate along with others. Of course, since you're not part of the key decision making, your liability is also limited. So if a tenant sues the management team, you are protected. Number 2, which is somewhat related to number 1, is relatively small ownership share. At least in today's environment, most syndications are structured by splitting ownership to 30% for the management team and 70% for the passive investment. And so your ownership will be based on the total amount that you invested off of that 70%. In other words, it may end up being relatively small, but of course the cash flow in terms of monthly or quarterly distributions that you receive could be quite meaningful. Sometimes, or very often actually, the management team would also cap the amount that you can invest because they don't want to lose control of the deal or have a passive investor effectively dictate how the business plan needs to change from what they originally intended. Number 3 is a meaningful and upfront investment amount starting anywhere from $50,000 to $100,000, which can be, and it is, a lot of money for many people. Now, sometimes sponsors may be willing to accept a lower amount, particularly for waitlisted investors, but that is something you want to discuss one-on-one with the sponsor that you're speaking with. Number 4, it's a long-term, illiquid investment. For most syndications, the planned hold period is anywhere from 3 to 7 years, and in the current market, not uncommon to see 5 to 7 year holds, which effectively means that you need to plan to have your capital in that deal for the next 5 to 7 years. Unlike REITs or unlike stocks and bonds, you don't just freely trade in and out of a deal. If you're facing extenuating circumstances, the sponsor may have options to buy out your shares, or there may be other LPs who buy out your shares, and very often all of that will be defined up front in the operating agreement, but it's not guaranteed and certainly not common. And number 5, last but not least, is the complexity. Syndicating and managing large apartment complexes is not an easy task, and certainly that's one of the many reasons why it is a team sport. There is a lot of work that goes into forming the management team and making sure you have the right captains to direct the ship, doing diligence on the market and submarket, underwriting the property, and once that property is under contract, doing full diligence before you close and sign on that dotted line, looking at documentary diligence, financial diligence, structural diligence, and so forth. And once you close on the property, there's a lot of work that goes into managing that property, improving the bottom line, so you can achieve the desired higher valuation at exit, and effectively executing on the business plan. So it's certainly not a job for one person. There are many involved, and it's a complex process. So if you don't want to deal with that, that's fine as a passive investor, but if you do, and if you want to be heavily involved in each and every aspect of that process, then syndication may not be a good fit for you. So that's it. We hope you found today's content helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.